Before you do the one thing your brain is screaming at you to do right now, before you open your app and tap sell, give me 20 seconds. Because here is the promise of this video, by the end of it, you will know exactly where to put your money when the market is falling apart. And here is the painful truth. In the last major correction, Indian retail investors pulled out over 1 lakh crore rupees at the worst possible time, locking in their losses and missing the recovery. 9 out of 10 of them will tell you the same thing later. I wish I would just held. So today I'm giving you a 4 layer map. Layer 1, safety money. Layer 2, your waiting money. Layer 3, your stability money. And layer 4, the money you should not touch and might even keep buying. Stay till layer 4 because that's where most people get it completely backwards. Layer 1. And this is the layer that stops the panic before it starts. Here's the single biggest reason people lose sleep when the market falls. They have money in equity that they actually need soon. Rent, a wedding, a down payment. The moment the market dips, that money is in danger, and then brain goes straight into the survival mode. So imagine this with me. It's 4 months before your wedding or a few weeks, the last date of your college fee payment. You are saved 3 lakhs for it, and being the smart investor, put it in a equity fund. Now the nifty drops 15% in 3 weeks. That 3 lakhs is now 2 lakh 50,000, but the action dates does not move. What do? You sell at a loss, not because it was a bad investment, but because you put your short term money in a long term asset. That's not a market problem, that's an asset allocation mistake. So here is the rule. Any money you will need in the next 0 to 3 years does not belong anywhere near the stock market. Equity is volatile in the short run. A 20-30% swing in a single year is completely normal. Over 10 years, that volatility smooths out. Over 10 months, it can wreck you up. So, where does safety money go? 3 clean options. First, a high yield savings account for your instant access buffer, roughly 1 month of expenses. 2. A liquid mutual fund for the next chunk. You get around 6 to 7%. You can redeem it in a day. 3. A short-term fixed deposit or a sweep in FD for money with a known date. Your target here? Build an emergency fund of 6 months of expenses first before you worry about anything fancy. Because when this layer is solid, market crashes stop feeling like emergencies. They start feeling like opportunities. And if you're not sure how big your emergency fund should even be, I have built a simple emergency fund calculator that does the math for you. Link is in the description. Grab it, fill in your numbers, and come back. Here too. This is the money you do not want to invest for the long term, but the market's red and every cell in your body is saying, wait for it to fall more. Now, I want to show you something. Go on Reddit and look for India investments during any correction, and you will find this exact post every single time. Should I stop my SIP and wait for the bottom? Hundreds of upvotes, and the top comment is always some confident guy saying, keep cash ready bro, wait for the crash. Sound correct now? There's just one problem. That guy has been waiting for that crash since 2021 with the belief that he will magically know the bottom and jump in at that perfect moment. He won't. Nobody does, not the fund manager, not even me. Here is the mechanic that actually matters: rupee cost averaging. When you keep buying through a fall, your fixed amount buys more units when prices are low. Volatility isn't your enemy here, it's literally the engine that lowers your average cost. The investor who kept their SIP running through a crash almost always ends up ahead of the one who paused and waited for the clarity. So, what do you exactly do with a lump sum you are scared to deploy? Do not freeze it and do not dump it in all at one shot. 2 steps. 1. Park it in a liquid fund or an arbitrage fund so it's earning something while it waits instead of rotting in a savings account. 2. Set up a systematic transfer plan, an STP. It automatically moves a fixed amount every week or every month from that safe fund into your equity fund. You get the discipline of an SIP and the averaging benefit without you having to make a single emotional decision. Park it, drip it. Don't freeze it, And that's the whole game for layer 2. Layer 3 is where most young investors are weakest because it's boring, and boring doesn't trend. This is your stability layer, the part of your portfolio that's supposed to hold steady while equity swings. Think of your portfolio like an Indian cricket team. You cannot field 11 batsmen and expect to win. Your equity, your index funds, your stocks, those are your batsmen. They score the big runs, but on a bad pitch, they collapse. Your debt, that's your bowlers. They don't score much, but they defend the total when the batting falls. And gold. Gold is your all rounder. It quietly does its job when everyone else is struggling. A team of only batsmen looks exciting for one over, then it loses the match. Diversified asset allocation is just the same, picking a balanced 11. Now let's talk real instruments because this is where the tax details actually matter. Everyone's default is the fixed deposit fund. Fine, safe, but remember FD interest is taxed at your full income slab. If you are in the 30 bracket, a 7% FD is really giving you under 5% after tax. Debt mutual funds give you liquidity and market linked returns, but under the current rules, gains on debt funds bought after 2023 April are also taxed at your slab rate. So, no magic tax break there anymore. But here is the underrated king, the PPF, Public Provident Fund. Right now, it pays 7.1%, and here is the part people miss. It's EEE, exempt, exempt, and exempt. Your investment is deductible, the interest is tax-free, and the maturity amount is tax-free. For a 30% bracket earner, a tax-free 7.1% is genuinely hard to beat on a risk-free bias. The catch is the 15-year lock-in, so it's your long-term stability money, not your emergency fund. And then a small slice of gold through a gold ETF or digital gold, not jewelry. Historically, when equity gets hammered, gold often holds or rises up. That's the hedge. A modest allocation, many investors keep it around 5 to 10%, can genuinely cushion a portfolio in a crash. Now, how much in each equity, debt, gold? Depends on your age and goals, and I don't want you to keep guessing. So I have made a simple asset allocation template where you drag a few sliders and it shows a balanced split. Its link is in the description, please check it. Layer 4, and I want to be honest with all of you here because I learned this one thing the hard way. 2020, my first real crash, the market fell off a cliff in a matter of weeks and my portfolio was down about 32%. I remember staring at that red screen at 2 am, heart pounding, and I did the exact thing I'm telling you not to do. I panicked. I sold. I told myself I was being safe. And then I regged from the sidelines in cash as the market recovered and blew past the price I sold at. That one emotional decision cost them more than any bad stock ever did. That's the real cost of panic. It's not the crash, it's what you do during the crash. So let me show you what I should have understood. Pull up a 20-year chart of the Nifty. Every single crash on it, 2008, 2020, every scary correction in between looks terrifying in the moment. And every single one in hindsight became a buying opportunity. The line always dips and then makes a higher high because it's tracking the long-term growth of Indian companies. Here's the number that matters the most. The investor who simply stayed invested and kept their SIP running almost ends up dramatically ahead of the one who panic sold and re-entered later because they missed the sharpest recovery days and broke their compounding. Compounding punishes interruption. Every time you jump out and back in, you reset the clock on your own wealth. So what do you actually do with your growth layer, your index funds, your long-term equity when the market is bleeding? 3 things. 1. Do not sell. This money has a 7+ year horizon. Volatility is the price of admission for equity returns, not a reason to leave. 2. Keep your SIP running. Do not pause it. This is when it does its best work. 3. Rebalance, do not retreat. Once a year, if equity has fallen and your allocation is out of whack, move a little from your stable layer into equity to bring it back to the target. You're literally buying quality when it's on discount. Trim what's up, add to what's down. Remember the tax angel too. Staying long term isn't just emotionally it's smart, it's tax smart as well. Sell equity inside a year and you pay 20% short term. Hold it beyond a year, it's 12.5% with the first 1.25 lakh of gains completely tax free every year. The system literally rewards patience. The market doesn't reward the smartest person in the room, it rewards the one who can sit still. That's the whole secret of layer 4. So, there it is, the 4 layer map: safety, waiting, stability, growth. Get these layers right before the next crash, and volatility stops being scary. It becomes the thing that makes you rich while everyone else panic.